Good morning, everybody. So this is Invest in Africa Masterclass on Legal Clinic. This is going to be a very long session on tax in Kenya. How do you file your tax as an SME? What are the tax mechanisms the government is providing the SMEs with? And is the government willing to cushion the SMEs on tax? And if you have not been paying your tax, how does the government expect you to have a way of how do you pay back your taxes? What are the payment plans that are available for SMEs? So that is what we're going to have today. So I'm going to introduce who Invest in Africa is. So Invest in Africa is a pan-African investment organization and a trade accelerator, coordinating efforts across sectors to achieve greater skills, impact, and replicability than when acting alone. So Invest in Africa is an organization that we are a network. So we bring in different expertise, different organizations to work with us together. We don't run this, we are not a one-man show in this organization. So Invest in Africa is a network and a collaborators of organizations. And the other one to note about Invest in Africa is we are not a profit membership organization. So our membership include multinationals, corporates, associations, financial institutions who share a common purpose to empower enterprise and creative impact. So our creative impact is to ensure that our SMEs have jobs, and also an SME is trained. That means that you have the skills, the knowledge, and you can access markets, and also you can access finance. So those are core pillars of who Invest in Africa is. So our vision is to prosper African economies, and our target in terms of jobs to be created is 250,000 jobs that we are working towards creating for the SMEs, and 1 billion worth of contracts to be won by our SMEs. So this is a very ambitious vision, and our targets are high, but we believe that as an organization, we're able to achieve that. So our impact so far is that we have over 3,000 SMEs registered on our platform, which is called Biashara.now. So Biashara.now currently has over 3,000 SMEs. And as of now, we have supported 80,300 jobs so far. And we have been able to support SMEs access 300 million worth of contracts. So the purpose of the multinationals within the ecosystem, within Invest in Africa Biashara.now platform, is to provide tendering opportunities for SMEs. So for you to be an SME, you have to have also gone through the process of onboarding. You have to be part of the Invest in Africa SME network. So far, we've been able to facilitate 590 million worth of finance facilitated. As an organization, as Invest in Africa, this is what we've been able to facilitate. We are working towards ensuring that more SMEs can access finance. And then also we have been able to do over 2,000 SMEs trained. For the master classes only, we've been able to train over 3,000 SMEs. So that is an achievement for us for the SME Resilience Program. And the SME Resilience Program has 5 components. The first component is is a masterclass. So far as of now, we have this masterclass. And then we also have coaching that our SMEs have gone through. And we've had cohort 1 and cohort 2 for coaching. And then we have access to finance, which we are in our initial stages of access to finance. So our SMEs also have the ability to be trained on investor readiness. So kindly look out for any communication on investor readiness, apply for that. And this is a program that EY is running with us. And then we also have our Knowledge Academy. Our Knowledge Academy is a multilingual resource center. So basically it's a virtual library where we have all the masterclasses that we have done, every other conversation that we have been able to do. And then this is where we have put everything that we have been able to work in. So if you missed out a session in one of our masterclasses, this is where you get it. And then we also have peer-to-peer session. This session we have done 2 so far. And this was a session that the SMEs get to interact with a person who is already established in business. So you raise your questions, you raise your concerns, and they're also able to answer it. So you learn from one of your own SMEs who is already having bigger transactions, who is done through the challenges, various challenges. So that is what our SME Recovery and Resilience program has been about. So today's session, as we started before, is that it's a tax advice session. So we're basically getting legal advice from our lawyers here. And one of them is the overview of the tax legislation in Kenya. What kind of tax systems are there? How do you calculate your tax? And what are the supporting documents that you need when filing your tax? So that is why we're having this session today. And the other one is the review of income of tax session in Kenya. So we have different thresholds that as an SME you are taxed. So we are going to learn today that at what level are you being taxed by the government and at how much. So that is why we're having this session today. And then the other one is available tax cushioning mechanisms. So this is a session where we'll be introduced to, does the government have an opportunity for you as an SME to cushion you against tax, or when do you apply for tax cushioning mechanisms? And then the other one is, what are the current and emerging trends in the SME taxation system? And finally, we'll be looking at tax dispute resolutions and the procedures. So before you go to the court, before you go to courts, and how do you negotiate with the Kenya Revenue Authority for tax? If you have not been paying your tax, how do you negotiate for that? And what is the procedure for that? So that is why we're having this session, to learn on opportunities of engaging the Kenya Revenue Authority if you have not been paying your tax. So that is why we're having this session today. So I'll introduce who our lawyers are. So we have Samuel Kisu. So Samuel is basically a multinational companies acquisition and local foreign entities lawyer. He's also been involved in advising clients on tax disputes with the Kenya Revenue Authority, cross-border implication arising out of various agency agreements, and advising offshore companies setting their presence in Kenya. So Sam is aware of both the local tax and also the international tax that can involve any organization, an SME, a multinational, on setting up in Kenya, and what would be expected of. Sam also holds a Bachelor of Laws degree from Strathmore University, a certificate in international tax law and transfer pricing from the Chartered Institute of Taxation UK, and a certificate in entrepreneurship, emerging economies from the Harvard Business School. So we have a very brilliant lawyer with us. Samuel, we're glad that you're here with us. Thank you. And then we also have Benedict. Benedict is key areas of specialization are dispute resolution, and that is why we say that this would be a session on understanding how do you resolve disputes. So Samuel is here with us to understand that. And then also, that is Benedict, sorry about that. And then Benedict has been involved in personal wealth management, estate planning, succession matters on high net worth individuals and families. So if you have a business and you want to understand how do you divide your wealth among your families, how do you resolve conflict, what does the law say about your wealth as a business? So that is why we have Benedict here. And then also Benedict holds a Bachelor of Laws degree from Strathmore University and a postgraduate diploma in law from Kenya School of Law, and is an advocate of the High Court of Kenya as well as a CPA holder. So that is what, those are our two layers that we have today. And we are going to encourage that please interact with them, try to understand them, try to understand what are the legal resolutions that they're going to give us today. So Karibu Sam, Karibu Benedict. Thank you.
All right, thank you very much, Felicitas, for the introduction. I believe I can be clearly heard, and you can see my screen. So just a quick introduction, because the content we are to cover today is quite substantial and heavy. This is just who Africa Law Partners are. We are a boutique corporate commercial law firm based out of Nairobi, and we are members of the international network called ISFIN, where we have partner offices and partner professional relationships in 75 countries spanning over 5 continents. These are our areas of specialization. I'll just highlight general corporate and commercial law, tax law, Islamic finance, M&A, real estate, capital markets, dispute resolution, IP, competition, corporate governance, data protection, and then employment and labor law. Our qualification statement is quite lengthy. This is just to highlight part of it. For more information, you can visit our website, which we will display at the end, africalawpartners.com. So I shall proceed to start off the session, and because I am speaking on a very small area, I shall endeavor to go through it very fast, so we can leave a lot more time for my partner Kisu to cover the tax bit of it. So business contracts is a very, very wide topic. In fact, in law school, contracts class is divided into 2 or 3 semesters because of how heavy and how wide and how far-reaching and how consequential contracts are and have been for, perhaps since the beginning of time. I think even Adam had a contract with God and he breached it. So contracts have been there. It's a very wide topic. So what I will endeavor to do in my presentation is to cover just very specific areas, which in our opinion, we thought are key areas that SMEs need to consider as they enter into contracts with, with various other, with various other businesses and business persons in the market, both locally and internationally. So just to quickly go through the local legislation that is essential to the drafting, negotiation, review, adjudication of contracts. Number 1, obviously, is the mother law, which is the Constitution of Kenya 2010. And number 2 is the Law of Contract Act, which is Chapter 23 of the Laws of Kenya. Number 3 is the Consumer Protection Act, and number 4 is just the general body of law known as case law. This is essentially cases that have been decided by courts and other, dispute resolution mechanisms, just arbitration, mediation, etc. So I'll quickly jump into the key terms that, or the key areas in contracts that should be considered. Number 1 is the validity of a contract. For a contract to be valid, there are 3 elements that need to be there. Number 1 is an offer. Number 2 is acceptance. And number 3 is consideration. Consideration simply means giving something for what you are getting. So if you're getting a service, you give something in return. It can be money and the other forms of consideration. If these 3 elements are missing from a contract, that contract is an invalid contract, a null and void contract. One of the other things that we want to address as well under validity of contracts is a lot of people are fond of entering into memoranda of understanding. At law, strictly speaking, an MOU is not an agreement unless it has these 3 aspects. Even if it's called an MOU, most MOUs are what at law are called simply agreements to agree, that we agree that we will agree at a different date. And those MOUs are also invalid. So when it comes to validity of a contract, one needs to be very careful to ensure that an offer has been made, that offer has been accepted, and there is some form of consideration in the contract. The next aspect is the aspect of exclusivity. Depending on the nature of the business relationship and what is being done, what the aim of entering into the contract is. The issue of exclusivity needs to be looked at. You will find that because of the nature of the relationship, you may need to extend some exclusivity over that contract for that business relationship to make sense in itself. And this ties in with the last point in this slide, which is restriction to enter into other contracts. You'll find that in some contracts you will be, which is something you need to consider very carefully and make sure that it is either included or not included in the contracts, depending on what the understanding is. Because some people can sneak in exclusivity provisions where you are more or less tied to them. And the day maybe you want to expand your business, you want to maybe change services from whoever you're getting it from or change the nature of the relationship, you will find you will have been locked in into that contract for a certain period, right? So it's important to have in mind the issue of exclusivity for the duration of that contract and of that business relationship. The third aspect is non-disclosure. Sometimes, and we have had SMEs talking about this, especially those in niche services or in niche products, that someone may decide to just simply drag you along a business relationship, along a contract, and all they're doing is simply mining data from you. So it is important to ensure, and they may mine the data from you and not enter into any business relationship with you, and go and use that information to perhaps set up a competing entity to yours or sell it elsewhere, etc., etc. So it is important to make sure that you have a non-disclosure provision, at least for a period of time, 3 years, 5 years, depending on how niche your product is. Always ensure that you have a non-disclosure term in the contract that is very well drafted, very specific, to ensure your protection. The other, which we had touched on in the last session about a month or so ago, was the issue of IP protection. A lot of information is passed, a lot of trade secrets are shared, a lot of copyright material is shared. So it's important to make sure, again, touching on non-disclosure, to make sure that the intellectual property that will be shared in the course of the business relationship is properly protected. This not only ties to registration, where registration is necessary with KIPI or KICOBO, WIPO, whichever entity is applicable, just to make sure that that information for the duration of your relationship is properly protected, so that it's not shared around and then it loses essentially its value. Number 3, and this is obvious, which is probably the only thing most people look at, because it's a business relationship, the aim here is to make a profit. People only look at the payment terms. So under payment terms, it is important to ensure that the payment terms are very well defined, how the money is going to be paid, where it's going to be paid to, how long it's going to be paid to, if there are milestones, that the milestones are defined, and the payment for each milestone is also very well defined. The other thing you also need to ensure is included in a clause touching on payment is interest on late payments, especially to SMEs. And we've seen this, we've experienced this. We have seen people complaining on social media that because the SMEs are considered, quote unquote, small, maybe the big boys might decide to take advantage because they know you need their business and there's not really much you're going to do, that they will simply delay your payment, whether it's out of a genuine interest, rather a genuine reason, or a reason that is beyond them. This is something that's happening. So it's important to ensure that you cover the issue of interest on any late payments that are going to be made to you. The other aspect is on amendment of flexibility. Now, this is essentially a very commercial term to the contract, because it is only the parties to the contract that understand how flexible their relationship is, how flexible it should be, how rigid it should be. So it's important also you put in flexibility provision, so that if 6 months down the line, maybe the relationship is not working as we had envisioned, you can write to the other party and agree that let's amend this agreement because we find that this is not working for us, and maybe it's not working for you, or maybe it has become unfair to us the way that part of the agreement is operating. So it's important to make sure you have an amendment of flexibility provision to cater for that. Otherwise, it can be very difficult to amend a contract after that, and you might find yourself at a loss. Next is unfair or unconscionable terms. And with this, I'll touch on the Consumer Protection Act. You will find that because of the nature of the entity that you are engaging in, and they end up drafting the contract, you may find that that contract or some terms of it are very unfair to you. But sometimes as an SME, you find yourself at a very funny position because you really need the business, you really need to work with these people. So sometimes you just end up accepting that unfair term in the hope that maybe it will not materialize. So there is some form of protection offered for such terms, so that if a term is very unfair and it sort of crystallizes, you may find various protections under the Consumer Protection Act and also from courts. However, courts are very, in most cases, courts are unwilling to interfere in private relationships or private contractual relationships between entities, because their assumption is that you negotiated, you agreed, you signed, you accepted the terms of the contract, so we have no business interfering. However, when a term is very unfair, a court may come in and impeach that term. And also under the Consumer Protection Act of 2012, you will find some protections offered to parties where certain terms are considered unfair to the party. The other thing to have in a contract is also a dispute resolution clause. And this is essentially just to cover when a dispute arises, or you fail to agree. It's important to stipulate how the dispute is to be resolved, and within a certain period, so that you're not engaged in battles over a very long period, which then ends up interfering in your core business. Something else I want to mention here. There is a general belief that in every agreement you should have an arbitration clause, because arbitration has become the go-to dispute resolution mechanism, because people say courts they're windy and you take long and expensive and lawyers and all that. It is generally advised that if a contract is of a small value, and we would put it at maybe $1 million or $2 million, if it's below that amount, the contract value, it is advisable not to have an arbitration clause, because you will end up spending arbitration. As much as it is considered speedy, it is also fairly expensive. So if the contract term binds you to arbitration and the contract value is low at $2 million, you may find that you will end up spending more on arbitration fees, on lawyers for the arbitration, than what you're actually making from that contract. So sometimes when the contract value is small, at least leave some breathing room so that you can go to court, because courts will be much cheaper in resolving small disputes, especially now that we have a small claims court. So sometimes those are certain things that you need to consider. Moving on, the other term is a force majeure term. And this has especially come to light now during Corona, when COVID hit and some people did not have terms to cater for, contract, performance frustration, because this is nothing anyone could control. So this is a very, very important term to include in your contract, to cater for unforeseen circumstances in the future that are beyond any of the parties to the contract's power to control. An earthquake may occur, a tsunami may occur. Those are things that are beyond your control. So the contract should be able to stipulate what happens in those cases and how long you can then extend the performance of the contract for. The other thing I will touch on are warranties, indemnities, and representations. So for warranties and indemnities, let me explain what a warranty is. A warranty is a specific statement of facts that you know that this is a fact, so you can warrant it in the contract. In case such a term is breached, then you are allowed to claim for damages on what exactly has been breached. So these are specific damages. If I state that I am selling you a cup and I know that's a fact, and I end up selling you a bowl, you should be able to get damages for that breach of that statement of fact. An indemnity, on the other hand, is materialization of a known risk. So at the point of making the contract, you might know maybe in 6 months, in 7 months, this cup that I am selling you will break because it has some defect to it. So when that risk crystallizes under indemnities, the party that is at a loss should be able to claim when that risk crystallizes. Representations are simply exactly that, representations or statements made to induce you to enter into a contract. So if you enter into a contract with someone and they promise they can deliver A, B, C, D, and they know it is a falsity, it is not factual, they cannot deliver A, B, C, D in 6 months, and you can prove that they used that to induce you to enter into that contract, then on the breach of deliverance of A, B, C, D by that party, you can be able to repudiate the entire contract because the representation that was made to you to make sure you enter into that contract was in itself false. So the other issues as I wind up that I'd like to mention is that please ensure that any contract you entered into, if you can't have it, have a lawyer quickly look at it so that you don't find yourself at a loss. The lawyer might charge you a small fee for reviewing it, but you will suffer more losses if you fail to engage a lawyer and things go belly up in the future. Then the last item I want to mention now on specific contracts. I just highlighted the laws here that cover contracts in a very general manner. You will find that in certain sectors, in the health sector, in the finance sector, in the power purchase sector, those sectors and agreements in those sectors are, because of the nature of the sectors, can be so specific so that an agreement or how the agreement is made is governed under a certain law, under the CMA Act, under the Banking Act. Important to also be aware of which sector you are entering into and understand the dynamics of that sector so that you don't end up entering into a contract that under the laws of that sector, the contract is void. So I shall conclude my presentation there. If there are any questions, you can post in the chat, and I'll hand over to Kisu to go on with the rest of the program. Thank you all very much.
Thank you all for taking your time to listen to Benedict and I today. So I think let me begin with the legislative framework for tax in Kenya. There are about 10 pieces of legislation you have to be aware of with respect to tax in Kenya, and they're there on the screen. So locally you have the Income Tax Act, the VAT Act, excise duty, stamp duty, tax procedures, tax appeals tribunal, miscellaneous fees and levies, County Revenue Act, and the Finance Act. And then from an international scale and regional scale, you have the East African Community Customs Management Act, double tax treaties with various countries. So that's between Kenya and various countries. And then you have persuasive guidelines by the OECD, which essentially are supposed to assist the Revenue Authority and any other person attempting to interpret certain international tax laws. They look at the OECD guidelines to help them. So I think let me begin with the lengthiest and substantive tax law in Kenya, which is the Income Tax Act, which I believe has been the bane of many people over quite a number of years. And even experienced tax consultants keep learning about it on a daily basis. And that also includes the Kenya Revenue Authority. So this will just be an overview. Being such a notorious act, questions would would be very specific to certain issues that arise from that act. So this will just be an overview. So when does the Income Tax Act apply to you? It applies when you're making gains and profits from a business, employment, of where you have granted someone the right to use your property. Second aspect is which is a new phenomenon and is being which carries issuing guidelines on a daily basis, which is a digital marketplace. Dividends and interest, certain disposals, for example, like when you sell your land or when you sell your shares, or if you are in the oil and gas sector and you sell your right to your mining right to another oil and gas company. Kenya tends to charge a hybrid of between source and residency taxation. What do I mean? For Kenya, the general rule is the income is only taxable if it was derived from Kenya. If you derived income from Cambodia or Zimbabwe, that income is generally not taxable in Kenya. However, there are exceptions. Where you're carrying on a business with the same entity in both Cambodia and Kenya, then for Kenyan tax purposes, that all the income is deemed to have been derived from Kenya. The next aspect is employment income. Kenyan tax residents have the employment income globally is taxable in Kenya. So it's important to know that when you intend to denounce your tax residency, not your citizenship, those are two different things. When you intend to denounce your tax residency in Kenya, it's important to also cancel your KRA PIN before you start earning an income abroad. And you have to notify this to the commissioner. Otherwise, your income will be taxable in Kenya. The next aspect is the types of income tax. So there's pay for employees, corporate income tax, rental income tax, capital gains tax, withholding tax, advance tax, turnover tax, minimum tax, and digital services tax. So I think the most common is pay, which is paid on employment income. And it's payable on the graduated scale that's on the left. And these are annual amounts, not monthly amounts. However, the employer, as an SME where you employ people, you'd be required to withhold their income tax or their pay every month and submit it to the KRA by the 9th of the following month. This is something that I've come to experience some employers don't do, and KRA comes knocking 2 years down the line, and that time the liability is in the millions. So there are certain reliefs that you get from pay, which are right here on the slide. So insurance relief, the annual personal relief. These are keyed in the tax ledger on iTax. These are keyed in on the tax ledger on iTax. So corporate income tax is a tax payable on the income, on the taxable income of a company. How do you calculate taxable income? This, the revenue, that's the top line revenue. And the Income Tax Act provides for certain allowable deductions. And the general rule here is you are allowed to deduct all expenses which have gone directly into creating the revenue which you have earned. That's a general rule. There are about 26 instances in which the Income Tax Act provides for. I think that's very specific and it's not the subject of this presentation. Yeah, because the 29 instances. So the resident rate is 30%. That's for a resident company. Residence is attained immediately you incorporate a company in Kenya. That's a resident company. Another way of attaining residency is where a foreign company is, where the management and control of that foreign company happens in Kenya. Then the commissioner of the Commission of the KRA can deem that company to be resident in Kenya. It's worth noting that in the current legislative framework, management and control are pretty vague terms. And if you have had a look at the finance bill for this year, there's an attempt towards making it more clear what management and control mean. So corporate tax is paid through the installment tax format. The installment tax format is essentially, this is year one of your business, of your company. You estimate what your taxable profit would be, and you pay that amount on the 20th day of the 4th, 6th, 9th, and 12th months of the year. Hope that's clear. Where there is a deficit, then the deficit should be covered after 4 months of the year end of the company. Say the year end of the company is December, and there's a deficit of say 20,000 shillings or 30,000 shillings. By the end of April, you should have paid that deficit, and then you file your return by the end of June. Your annual tax return by the end of June. I think that's clear about the installment tax. Sorry, that was for year one only. For the subsequent years, the method for calculating installment tax is you take what your actual taxable profit was for the first year, for the previous year, multiplied by 110, so that's 10%, sorry. You increase 10% on it, and then pay installment tax again on the 4th, 6th, 9th, and 12th months of the year. So the next aspect is withholding tax, which essentially is a tax which is withheld by a payer of certain payments and remitted to the KRA. So the most common instances of withholding tax is when you're paying out interest to someone else that is not a bank, when you're paying out dividends as a company, when you're paying out dividends to your shareholders, except where that particular company owns more than 12.5% of the dividends payer. Then the other instance is management and professional fees. So in this case, not all management and professional fees should attract withholding tax. It's only where if you aggregate the payments being made to the manager or the professional, and they come to an average of 24,000 shillings a month, aggregated over a whole year. That's when withholding tax becomes applicable in that instance. It's a bit of a technical maneuver, but yeah, that's how it works. Then the rates of withholding tax, they vary depending on the nature of the payment and the nature of the payee. So interest and dividends attract different withholding tax rates. And if the payee, the person you're paying, is tax resident in Kenya, then the rate is lower than if you're paying to a person who is not tax resident in Kenya. So, and this also depends on the different double tax agreements. Then, like I said, the person withholding has to remit this amount to KRA before the 20th day of the following month and submit to you or the payee a withholding tax certificate, which you can use to credit whatever tax amount is due in a particular tax period. Then the next aspect or the next common income tax is capital gains tax. Now, capital gains tax is paid on certain disposals, and the most common are land and shares. So how to calculate capital gains tax is you get the capital gain, which is the transfer value, which is the actual contractual value, and you remove the adjusted cost. Now, the adjusted cost can be different things, which is the price you acquired that particular asset, the legal fees incurred in selling it, and any other improvements that you have made. That's when you get the capital gain, and the tax on it is 5% of that capital gain. Then, yeah, I think that's fairly clear. But there are certain exemptions or certain transfers that are not considered transfers for the purposes of capital gains. For example, where you are transferring shares to your immediate family, and immediate family has actually been defined as spouse and children of that spouse. In instances where there's a succession matter and the property is crystallizing. Sorry, I can see something here from Kezia. Let me go back to it. So Kezia, on management fees and professional fees, yeah, there is not all payments should be subject to withholding tax. They should only be subjected to withholding tax where the aggregate amount, if you annualize the payment, is 24,000 shillings and above. So, for example, you get into a consultancy with, for example, yeah, Invest in Africa, and Invest in Africa is paying you 100,000 shillings, and that's a one-off. It's a one-off for 100,000 shillings. So if you divide 100,000 shillings by 12, it comes to less than 24,000 shillings a month. There's no obligation for Invest in Africa to withhold that payment. I hope it's clear. So now we go to advanced tax, and for SMEs, this may be or may not be important, but and I'm sure if you have the experience, you know that before you take your commercial motor vehicle for inspection, you have to pay advanced tax on iTax, and this is credited against your income tax payable at the end of the year. And it varies depending on the tonnage of the particular vehicle. And I've tried to put it there. I've tried to put the calculation for advanced tax on the slides. Now, this is the most contentious aspect. Okay, well, it's the most emerging and currently contentious aspect in income tax in Kenya. So minimum tax, first of all, was sort of suspended by the court pending the hearing of the case instituted by the Kitengela Bar Owners Association, which is essentially the minimum tax was imposed as a tax to try and widen the tax base as much as possible. Now, it is payable by every business, whether they make a profit or loss. And it's chargeable at 1% of the gross company. Now, why it doesn't make sense and why it, yeah, and why it may be thrown out is, for most SMEs, if you calculate, you probably have a margin of 1 or 2% on all your sales. If 1% of that is going to the government, you effectively paid taxes of close to effectively paid taxes of close to 100%. If your margin is 1%, yeah. So that's why it's still in court and it's not applicable yet. I think we can have a further discussion on it if and when the court decides. Probably by December, the court will have come to its decision. Then turnover tax, turnover tax is similar to minimum tax. However, it's chargeable to those whose gross turnovers are above 1 million and less than 50 million, which I think is very important for SMEs. Now, there is a method of setting the turnover tax paid to the corporate income tax due at the end of the year. It's a bit of a complex calculation, and I'm happy to have this discussion on a more specific basis with examples. So GST, then this is also an area of reform, which is happening due to the business models being adopted nowadays by digital companies, and the ease of scalability without entering into the tax bracket. So it's payable at 1.5% on the transaction value. It's not payable by the business. It is levied by the business on behalf of the carrier, just like the same way VAT works. I think that's the most clear example I can give. So tax saving. Now here it's important to think about how you're financing your business. Where you have a financing structure where it's heavily debt or shareholder loans. So for example, I have started a company and have capitalized it with 100,000 shillings. However, I issue to the company shareholder loans of up to 10 million shillings. That way I can reduce my income tax payable through payment of interest to me. As an individual, that interest is a final tax. The interest payable to me is a final tax, as opposed to where it's full equity and the only amount I'm getting is dividends. If the business never makes a profit, I'll never make money out of it. The second is always keep your business receipts. As I mentioned in a previous slide, there are almost 29 instances in which you can reduce your taxable income, and that's and that can only be evidenced where you have receipts. So anything you pay for as a business, if you keep the receipt and deduct it on your income statement, it is possible for it to reduce your taxable liability. The other two statutory reliefs are not such a big thing because they don't reduce your tax liability by that much. However, they give you opportunities to save, which, for example, home ownership savings plan, affordable housing relief, insurance relief for you and your employees. It's possible to deduct those from your revenue, from your top line, in order to achieve a more reasonable taxable income. Then there's capital allowances, but these would tend more and more to apply to higher infrastructure businesses or where you've acquired buildings and heavy machinery, which was amended last year to cater towards higher capital expenditure into a business. Then I'll rush through the rest. So, I mean, we have VAT here. It's a tax that's chargeable upon the supply of all goods and services except where they're exempted. Now, it's important to note as an SME, it is illegal to charge VAT if you're not registered. The threshold for registering for VAT is 5 million. If you expect to make taxable supplies of 5 million shillings and above in a period of 12 months, or if you have made taxable supplies of 5 million shillings and above within a period of 12 months. So there are different rates, which is a standard rate of 16%, 8% on petroleum products, and 0% on zero-rated supplies. Now, the VAT payable by an SME is you take the output VAT, what you charged as VAT as a business, and what you paid as VAT to acquire certain services and goods. The difference between that, the net amount, becomes the VAT payable. So if I paid 1,000 shillings in VAT, that goes towards my rent, or if I paid suppliers and all those people, and I charged my clients 2,000 shillings in VAT, The amount payable to KRA as VAT is 2,000 minus 1,000, so 1,000. So VAT is you're required to file VAT monthly by the 20th day of the following month, following a supply of goods and services. Excess duty it's imposed on specific goods and services. Not all goods and services attract excess duty. The rates may vary depending on the particular goods and services, and these goods and services are listed under the Excess Duty Act and at the bottom. So it would be important to just have a quick look through. So there's not much to it. There's not much to excess duty because it's on very specific sectors: alcohol manufacturers, cigarette manufacturers, banks, and telecom service providers. So it's very specific and not a common tax payable by SMEs. Then we have stamp duty. I think this is a least enforced tax, though it can really bite you if you don't know about it or if you've not paid it. So it's payable on certain instruments. For example, share transfer forms attract stamp duty at 1%. Land sales attract stamp duty at either 2 or 4%, depending on where the land is. 2% for rural areas, 4% for urban areas. So it's payable within 30 days of signing the particular instrument. So this is something you also have to specifically look into when you're signing onto an instrument to find out whether it's liable for stamp duty and paying it within time. Otherwise, if in the event of a dispute, that particular instrument can't be used as evidence in court. So it becomes a bit of a problem. Then, okay, now we go to more procedure. So we have the Tax Procedures Act, which essentially is an act to provide for tax registration, deregistration, and the relationship between a taxpayer and the Kenya Revenue Authority. It also provides, it is where you will get many of the penalties which are stipulated for under tax laws and other amnesties. I think one important thing to note is you're able to apply for amnesty under the Tax Procedure Act if you fit the criteria as an SME. It also provides for methods in which to address the particular commissioner. Then we go to the Tax Appeals Tribunal. But before I discuss on the Tax Appeals Tribunal, let's talk a bit about tax dispute resolution. You're sitting in your office and you receive a demand letter from KRA. The first thing anyone would do is to panic and just sweep it under the rug. More and more, and over the years, it's worth noting that KRA are a bit humane. They don't just come knocking doors down. The moment you get that demand, go to your station. The station will be on the letter. Go to your station, sit down, speak to the particular officer who signed against the letter, understand their position. So this is a very informal method of doing it, but which has worked in my experience almost 10 times now. You sit down with the particular commissioner, discuss with them what the issues are, come up with a quasi-informal method of settling the dispute. But after that, the KRA also allows for alternative dispute resolution, which was published not too long ago. And there's a framework for this dispute resolution. And it's worth noting that this framework also provides for a very quasi-formal method of dispute resolution. It's just a discussion between you and the commissioner together with your professional service providers. It could be your accountant, it could be a lawyer, and where you come to an agreement, it is put in writing and signed. And that's what will continue to govern the relationship between you and the KRA. I advocate for these methods because they're quick and they're less combative. Because if with the KRA, if you look militant or if you appear militant towards them, the next thing that could happen is they freeze their bank accounts, freeze your bank accounts, something which is well within their power to do so. And it'll take you 4 or 5 months before you come to a solution on how to lift the freeze on your accounts. So now let's discuss the tax appeals tribunal. The first thing about it is you can only approach the tribunal on undisputed taxes. Sorry, on taxes which are disputed. On taxes which are disputed, you have to clear all undisputed taxes before you approach the tax appeals tribunal. The first thing to note is you have a fee of 20,000 shillings to pay on filing the notice of appeal, and subsequently then there will be a response by the KRA. There'll be a response by the KRA to the tribunal, and it'll be just like an ordinary case, although the rules of civil procedure do not apply to the tax appeals tribunal, and that's why even accountants appear before it. The decision is issued by the tax appeals tribunal, which is appealable to the High Court, and it's typically what people would use to appeal to the High Court under the tax appeals tribunal is judicial review, which doesn't go into the merits. It goes into the process in which the tribunal issued the judgment. This is something that's been happening quite often since 2015. However, the risk with that is at the point where you lose, immediately KRA can come for whatever assets you have left or your bank account. But like I said, I always advocate for the quasi-formal method of dispute resolution first. Also, it assists you to get your affairs into order, it buys you time before now you invoke the formal dispute resolution procedure. Then the next act is the Miscellaneous Fees and Levies Act, which is essentially it imposes an export levy and the IDF, import declaration fees, and railway development levy, which are levied in very specific items. These are not a big deal unless you're a big importer of things, which in that case, your customs agent is better off at assisting you to clear them. So always look into having a customs agent. They're very conversant with these agency revenues. Then you have the County Revenue Acts. These are specific to each county, and they provide certain small taxes which the county is able to collect from different businesses, be it a license, be it a levy, be it cess for those who transport goods cross county. So they vary with each county. I think another aspect to keep in mind is the Finance Acts. These keep changing tax laws every year. As a business owner, it is advisable to just keep abreast of what's happening with the Finance Acts. They're published usually in tandem with the budget. So we're due for one soon, which will probably be finalized by Parliament in around August or September, if it's not too contentious. And one thing about the Finance Act is to note the commencement date of the various amendments. The Finance Act will provide some amendments will commence from 1st July. So the new tax being introduced or the new tax rate being introduced by the Finance Act could commence on the 1st of July, yet the act was passed in August the 10th. So you'd have to be aware of that. It could provide that the amendment commences on the 1st of January the next year. So 1st of January 2022 in this case. So it's just important to be aware. Though carriers has made an effort over the years to make people aware of when certain taxes will be commenced through the social media, through print media, and through the news. So this is something you shouldn't miss. And I think now just a brief overview of what the finance bill proposes. I won't get into details because it will change before it becomes an act. It will change. So there's an increase in withholding tax. Now digital taxation gathers its legs properly under this finance bill. Like I mentioned earlier, the definitions which have become more specific, such as management and control, and expands the definition of permanent establishments. More aspects are going to become exempt under the VAT Act, but this, like I said, it could change at any time between now and when it's passed. So we've discussed these local reforms. It's something to be aware about and just keep your ears open. It's something that will be coming soon. Even for minimum tax, the court could say, yeah, it could be imposed by carry, and then it becomes a headache for all of us. Yep, and that's it for me.
So we are going to share more questions. Please share your questions on the chat. We have already answered some, and we still have some. We have a question, Sam, which is from an anonymous attendee. What is the difference between minimum tax and turnover tax?
So, okay, the first difference between minimum tax and turnover tax, I think, let me just go back to them and put them together. So, I mean, the first difference is the threshold. If you make below £1 million a year, you will be subject to minimum tax and not turnover tax. That's the first difference. The second difference is if you look at your income statement, turnover tax is on the sales. It's payable on the sales, while minimum tax is on the gross turnover, including other income. So in that case, in that case, most businesses would be applicable for turnover tax. Sorry, for minimum tax, because where you have turnover tax and at the end there's a tax loss, then it can be carried forward. In the case of minimum tax, it's on your profit and loss completely. So it's a bit of a fine line, which is still being discussed and is the subject of a court case right now. So I think it would be clearer upon the decision of the court or upon the amendment of the act by the Treasury or by Parliament. KZ, I see companies who are below turnover of 5 million liable for installment tax. No, that's because you'll be in the turnover tax regime. George, first of all, withholding tax, this is from the context of the person paying. I'm the person who has hired the consultant. At any point that I pay that consultant, so if I'm paying them monthly and I pay them on the 30th of every month, if I pay them on the 30th and withhold the 5%, I'm required to pay withholding tax by the 20th day of the next month. So it's payable at any point the payment is made, whether it's monthly, annually, or quarterly. So a consultant who is paid a total of 50,000 per month. If the contract covers a whole year, and if you aggregate the payments for over a whole year, So if you aggregate the payments over a whole year, then yes, withholding tax is payable. If you invoice below 24,000, this will be found out from your bank account. The risk is minimal, but that's essentially tax evasion, if I understand the question correctly. Lena, the court suspended minimum tax. Does one need a withholding tax certificate if the purchaser makes direct remittance to Jerry? Sorry, does one need a withholding tax certificate if the No, you see, a withholding tax certificate is only applicable where there's a withholding tax paid. If there's no withholding tax paid, then there's no instance of withholding tax. It won't reflect on your iTax. The withheld amount won't reflect on your iTax. So there's no need for a certificate as evidence. I hope I'm clear. What regime is advisable for a startup between turnover tax and VAT? So, Mercy, these are two different taxes. Turnover tax is a tax on income, whereas VAT is a tax on supply on transactions. So, where VAT will be applicable, one, if you're registered. That means if you're making supplies of 5 million shillings and above. So that's when VAT will become applicable to you. Turnover tax will be applicable to you where your revenue or your gross turnover is 1 million shillings in a month and below 50 million shillings. So you see, there's a particular gray area where VAT will not be applicable. Then what's the other aspect I wanted to speak about? Electing between turnover tax. I think more often than not, it is more advisable to elect to pay corporate income tax as opposed to paying turnover tax, because you're able to elect doing so, and it's like I said, when we're talking about margins here, the percentage charged on your gross sales then becomes an issue if we're talking about margins. Okay, I see a question by Rita. So the computation of installment tax is as follows. In your first year, you estimate basically based on your business plan or a hunch, you estimate what your taxable income for that year would be, and then you pay against that estimate on the fourth. On the fourth, sixth, ninth, and 12th month. So on that estimate, where there's a shortfall, then you're supposed to cover that shortfall within 4 months of your business's year end. So like I said, if it's 31st December, by 30th April, you should have covered that shortfall. Now, for the subsequent years, you take the previous year's amount, multiply it by 110%. So you're increasing at 10% on your taxable profit. And then you go ahead and pay on the 4th, 6th, 9th, and 12th month. However, what happens when you've overpaid installment tax? Now, in the subsequent payment, you only pay what the balance would be. And just like I said, the most notorious tax law is the Income Tax Act, also because of how old it is. It's I think after the Stamp Duty Act, it's the oldest tax law in Kenya. It's very detailed on certain aspects and very ambiguous on others. And so sometimes, and more often than not, you'd find someone giving you the answer. And I've given this answer many times. It depends. it depends. So you have to dig deeper into the particular issues, look into documentation, sometimes even ask the KRA for a private ruling, which is something I should have mentioned. If there's a possibility of requesting a private ruling from the KRA on certain aspects, though it could take time before you get an answer. So sometimes you just jump in the water and wait for the sharks.
So if you want to get in touch with the Africa Law, we've just shared their contacts, their emails. So they are located at Swiss Cottages, number 7 Ring Road. That is the physical address on Riverside. And then we also have their telephone number, which is 0713 74 32 24. And then we also have the email address for Sam, which is smk@africalawpartners.com. And we also have Benedict at africalawpartners.com. So kindly get in touch with them if you need more advice. But at the same time, you can share your questions on our chats. We'll share with them, and then we'll also share them on your email. We'll personalize those questions and send them to them, and they will be able to revert. So kindly share more questions. If you feel that the questions you can't ask, share them virtually. You can send an email and they'll be able to share it. And then also we also get in touch with us at Invest in Africa. And if you're an SME who is interested in investor readiness, kindly also get in touch with us. Our investor readiness program just started. We are still at our initial stages, and we are still encouraging SMEs to apply. So please get in touch as well if you're interested in that.